What's going on, everybody? My name is Chase Lawson. This is the Financial Freedom Show where I make personal finance simple. Let's get started. So a lot of you have probably heard of a 401k and have likely heard of how good of an investment vehicle it is. But what exactly is a 401k and how does one even invest in it? So first off, where did it even get its name? Well, a 401k is called a 401k because it's derived from subsection 401k of the Internal Revenue Code. A 401k is similar to a 403b for those who work in education or for nonprofits, a 457b for government organizations, or a 401a. Since 401k is the most common, I will focus exclusively on that, but just know that if you are offered one of those other plans, they are similar in how they operate. So first and foremost, what is a 401k? Well, 401k plans were enacted into law back in 1978 through the Internal Revenue Code. The full text is quite lengthy and can be a bit complicated, but in essence, a 401k is simply a type of retirement account offered through many employers. By definition, it is an employer-sponsored retirement plan, so in order to participate in one, you must have a job and your employer must offer one. However, as I mentioned in my index card rules to investing video, most employers in America today do offer a 401k. A 401k is very similar to another investment vehicle known as an IRA or individual retirement account in that both types of investments are geared towards retirement, have tax advantages, and may be subject to penalties for early withdrawals. But as the name implies, an IRA is something individuals set up themselves on their own, not through their employer. And with an IRA, the money that gets invested does not come out of one's paycheck, whereas it does with a 401k. So how does a 401k work? First off, if your employer offers a 401k, they'll create the plan with a brokerage, such as Vanguard or Fidelity, and will pick a number of funds to offer employees to invest in with their 401k dollars. You, as an employee, will then just work with your HR department to create an account at the brokerage, choose which fund to invest in, and then define the amount you want to contribute from each paycheck, whether it's a set dollar amount or a percentage of your earnings. Once you set up these parameters, it may take a paycheck or two before your contributions begin, but then with each paycheck, you'll see that amount withheld from your check as it is funneled to your 401k plan. Simple enough. With a 401k, there are essentially two types: a traditional 401k and a Roth 401k, each with its own purpose and benefits. The biggest difference between the two is when your money is taxed. So with a traditional 401k, the money you contribute goes in pre-tax, meaning no taxes come out before the money goes into your 401k. As an example, let's say you contribute $100 per paycheck into your 401k. With a traditional plan, all $100 goes straight into the fund you selected when you set up your 401k. That money will then grow as you make more contributions and as the market continues to go up until you ultimately withdraw that money, at which point you pay taxes on the full amount of the withdrawal based on your tax rate at that time. So let's assume you work for 30 years and continue to contribute to your traditional 401k throughout your working career. You invest a total of $100,000 throughout that time, but due to growth in the market, it grows to $350,000. Were you to withdraw it all at that point and your current tax rate was 20%, you would pay $70,000 in taxes or 20% of the $350,000. and be left with $280,000. Note that this is the first time that taxes are ever being taken out on that money, whereas had you just contributed money from your paycheck into stocks and other investments, that money would have already been taxed up front, and then you'd be taxed again on the growth when you withdraw. So with a traditional 401k, you essentially defer taxes years down the road, which allows you to have more money invested longer, which ultimately can allow for greater returns. When setting up this type of account, it may just be labeled as pre-tax contributions to your 401k. Well, that sounds great, right? Well, there's another type of 401k as well to be aware of. That is what's known as a Roth 401k. With a Roth 401k, the money you contribute to the plan is post-taxes. So with our prior example, once again, assume you contribute $100 per paycheck to the plan. If you're taxed at 20%, $20 or 20% of the $100 will come out upfront in taxes, and the remaining $80 will be invested into your chosen fund. The benefit to a Roth 401k, though, is that that money then grows tax-free, and when you do ultimately withdraw the money, you don't owe any taxes on any of the growth. So with a Roth 401k, you pay taxes once up front and then never have to pay taxes again. So in this case, you may only contribute $80,000 to the plan during your working career due to taxes coming out of those contributions up front, but then it may grow to $280,000, at which point you can withdraw the full amount and not owe a dime in taxes. When setting up this plan, it may be labeled as post-tax contributions, which is the same as a Roth plan. So both plans sound great, but which one is better and which should you choose? At the end of the day, this is ultimately a judgment call and depends largely on current and future anticipated tax rates. I typically advise those at or near the beginning of their careers to consider a Roth plan, as your income will likely continue to increase throughout your career, so while you're in a lower tax bracket, it may make the most financial sense to go ahead and pay taxes up front and then never worry about paying taxes on that money again down the road when you may be in a higher tax bracket. In addition, if we look at historical tax rates, they are currently relatively low in comparison to some tax rates of the past. The highest marginal income tax rate is currently 37%, whereas from 1932 through 1986, this was between 50 and 94%. We don't know what the future will hold, but a lot of experts do predict that tax rates will only increase in the future, especially if any of these progressive presidential hopefuls ever take office. If that is to happen, then it makes the most sense to utilize a Roth plan. You'll end up keeping more money. In addition, when you do get close to retiring, it can be helpful to have more certainty to that money and know exactly how much you'll have to use in retirement. And since with a Roth plan, you don't owe any more taxes, you get to keep 100% of the money. Whereas with a traditional plan, what you see is not what you get, as you have to deduct taxes from that money. At the end of the day, it is your decision, and there are benefits to both, and you can certainly have both types. But to make the best decision, look at your current tax bracket and try to project your tax bracket at retirement. If you anticipate you'll be in a higher tax bracket, which many do end up in, then go the Roth route. If you expect to be in a lower tax bracket, go the traditional route. If you expect to stay in the same tax bracket, flip a coin, as that is the break-even point. You'll end up with the same amount that way. So there are obviously a lot of great things about a 401k, but another benefit is that oftentimes employers will offer a match on your contributions. It is typically between 50 and 100% of the first 6% you contribute. So if you make $1,000 per paycheck and you invest 6%, you'll invest $60 per paycheck, and your employer will contribute another $30 to $60 on your behalf from company money. Most employers who offer a 401k do offer a match, so that's a free, instant 50 to 100% return on your investment, which further makes a 401k a no-brainer. So now that you understand the benefits to a 401k, it is important to note some of the drawbacks. The main things to be aware of with a 401k is that since it is geared towards retirement, the IRS sets rules on when you can access that money. With both traditional and Roth 401ks, you cannot withdraw any money from the plan until age 59 and a half without being subject to a 10% early withdrawal penalty. There are a few exceptions to this rule, but just plan on not touching that money until you hit 59 and a half. In addition, you are required to start withdrawing a certain minimum amount per year once you turn 70 and a half or the year after you retire. If you don't take these required minimum distributions, you may owe 50% in excise taxes on the amount you failed to withdraw that year. You're currently capped on contributions per year to your 401k of $19,500 unless you're 50 or older, in which case you can contribute up to $26,000. Finally, your employer may offer a very limited selection of funds you can contribute to for your 401k, but you can usually find a good fund to contribute to, such as a target retirement fund. If you do ever end employment with a company, you can typically roll over your plan into your new employer's plan or into an IRA plan. So I hope this video helped you to better understand what a 401k is and the benefits a plan like this offers. If you are among the up to 2/3 of Americans not currently contributing to their employer's 401k, I highly encourage you to do so, especially if your employer offers a match. Just know that this money is earmarked for retirement and therefore should not be touched until that time. The benefits to a 401k far outweigh any drawbacks, so definitely take advantage of this. I hope everyone enjoyed this video. Please, as always, like, comment, and subscribe so that I know you received value, and let me know what other topics you want me to cover. Thanks, and go get them.